Hi, Bruce Miller here of Miller Financial Group LLC. Welcome to our first video presentation of 2013. I'd like to take a few moments of your time today to talk about what's happened in the last week and what are some of the factors that caused the activity in the last week, which has been so unusual. After that, I'd like to cover some of the things that we see going forward that might affect the market. And lastly, given all of the factors, where do we see us headed from here? Well, last week, what a week it was. What a sell-off we had in the markets, but mostly in commodities. Take gold, for instance. In a 2-day span last week, gold lost $200 an ounce, an amazing drop and almost unheard of. So it transferred over to other markets. Why did that happen? Well, you see, when people have to sell gold to cover a margin requirement, they have to sell other assets to get the money to cover the margin. Hence, a big disruption in any market may cause other markets to drop likewise. That's one of the things that we saw last week. But we also saw a couple of other things. One, it's been a great year so far, and perhaps people have been waiting to take some profits. We call that profit taking. And lastly, we're starting to see some softening economic reports, and I have to attribute that to the sequester. Now, the sequester is part of the fiscal cliff that we talked about a few months ago. The sequester being the automatic budget cuts that occurred because of all the negotiations that happened last year prior to the fiscal cliff. And although it's not having a major impact, we are seeing some softening in several areas. We're seeing some unemployment issues, not huge, but some minor issues. And also we're seeing it reflecting in some profit margins of some of the companies. But the story this year has pretty much been two items. One we already talked about, that is gold being down 17% for the year. Unusual because it has been such a positive on the markets over the last few years. And secondly is the story of Apple stock. Why Apple? Well, Apple was a huge contributor to our investment gains last year, representing nearly 20% of the gain of the NASDAQ last year. And this year, Apple stock is down 29%. Now, if you think about that, it's been a fairly robust market to grow the way it has, in spite of the decline of Apple stock. So what do we see going forward? Well, I see a lot of positives and a few negatives. On the one hand, I see extremely accommodating fiscal policies on the part of the Federal Reserve. It appears that they're prepared to keep interest rates at an all-time low for an extended period of time. Easy money, low interest rates into the foreseeable future. Also, what we're seeing is an expansion of these policies internationally. Only a couple of weeks ago, Japan announced a remarkable expansionary policy based upon U.S. results. Whenever money loosens up, whether it be domestically or internationally, it's going to have a positive impact on investments of any kind. Next, we see a surging real estate market. Today we saw a report that would seem to be negative in the real estate market, that being a decline in sales. But you have to look beyond it. Why did the sales decline? The sales declined because the inventory was not there. We have gone through so much real estate inventory that inventory levels are at an extremely low level. So in a sense, that's a good thing. We're seeing an uptick in the value of real estate, and we're seeing other indicators that indicate that housing is actually picking up. Construction is picking up as well. Low energy prices. Oil has come under a lot of pressure recently. It's about $88 a barrel, quite a drop. And I'm sure you've seen at the pump, gasoline is below $3.50 a gallon. And that's going to have a positive impact eventually on corporate profits and on people's pocketbooks. A real positive. But there are some negatives. One of them I already talked about, and that's the results of the sequester, the third leg of the so-called fiscal cliff. It will result in lower GDP, higher unemployment, squeezed profit margins, and generally softer economic data across the board. Another thing that always occasionally rears its ugly head is the European situation. There's still a lot of problems in Europe. We're not seeing the improvements that we thought we'd see. It appears they may continue to be mired in recession for a period of time. Fortunately, they've somewhat decoupled themselves from our market, so we're not as influenced as we were by it a year or two ago. Another factor is an anomaly that I'd like to explain to you, and it's called sell in May and go away. It's one of many anomalies in the stock market that some investors adhere to. And when they adhere to it, you'd best pay attention to it. And it's the fact that most gains in the market are between November and April, and therefore many people sell in May and don't re-enter the market until November to take advantage of the profits from November through April. Again, even though whether it works, whether it doesn't, if people pay attention to it, it can become a self-fulfilling prophecy. So with all those positives and the negatives that I talked about, where do we see us going forward? Well, I don't think it's going to be a smooth ride. I think there'll be a lot of ups and downs, but I expect that global monetary expansion in the US and Japan and other countries that may climb on board will send the market to new highs. Low interest rates and a surging real estate market will combine with easy money policies to cause a good economic expansion. Yes, the sequester will be a factor, but it will only be a small dent in what looks like a very vibrant recovery. And it may make it easier for the Fed to keep interest rates lower for a longer period of time, because it may provide the brakes that the Fed sometimes requires to slow an overheating economy. So in summary, I hope this brings you up to date a little bit about what we're seeing in the market and helps you go forward with a little bit more confidence, because I have a lot of confidence in the markets at this point. So Ben, let's go make some money.